REIT investing. What is it and how does it work? Understanding what a REIT is and the power of what you're investing in is a vital step if you're jumping into this world. You may find their technical part or history a little stagnant, but stick with me because it's worth it. Let me start with the basic definition. A real estate investment trust is a company that owns real estate that is income producing over multiple sectors. For example, a company owns warehouses and hospitals and rents them out. There are specific requirements for a company to qualify as a REIT. According to REIT.com, the following are required. Number 1, 75% of the company's total assets must be in real estate. Number 2, 75% of the company's gross income must be from rents from real property, the interest on mortgages from financing those real estate properties, or the sale of real estate. Number 3, they must pay at least 90% of the taxable income they receive as dividends to shareholders each year. Number 4, they must be a taxable corporation, not a nonprofit, for example. Number 5, a board of directors or trustees must be in management. Number 6, requires at least 100 shareholders. Number 7, 5 or fewer shareholders cannot own more than 50% of the company's shares. In basic terms, a REIT allows you to become a shareholder in a company that pays you from its rental income. You are essentially a landlord without all the burden or hassle. The last part of the more technical stuff is knowing that there are different REIT types. Equity REITs. The large part of REITs on the stock market are equity REITs. They generally own income-producing properties. When you hear REIT discussions, they're mainly talking about this kind. M-REITs. Mortgage REITs earn income by producing or originating mortgages and then pay their shareholders via the interest earned from the mortgages or mortgage-backed securities. Public non-listed REITs, PNLRs, are REITs registered with the SEC, the entity that monitors trading in the United States, but they aren't available for trading on stock exchanges. Private REITs. These REITs are privately held, do not have to be registered to the SEC, and are not available for trading on the stock exchanges. How does it work? You can own a REIT by opening a brokerage account to purchase stocks, research your options, and find a REIT that works for you. Once you purchase it, that's it. You are now the proud owner of a REIT and can expect to get paid passive income dividends for each share. A REIT must pay 90% of its income to shareholders as dividends. The payout on this can vary depending on the REIT you purchase. Once you purchase a REIT, you're required to hold the stock for a certain period before receiving dividends. Depending on the REIT, you might get paid once a month, quarter, year, and everywhere in between. You'll want to research each REIT and see which works best for you. The website allreits.com is a great place to start researching your options. They have great free tools to compare different REIT options and see which work best for you. Why invest? Owning a rental property is not too far-fetched for some people, but imagine owning an Amazon warehouse or a group of hospitals and being the landlord for that. Unless you have millions or billions of dollars, you will not likely be the landlord for such properties. With REITs, you can. When you look at the portfolios of properties for some REITs, you'll see that some tenants they rent to include large corporations like Amazon. Because they pay their shareholders from their income, you're essentially getting part of the rent that Amazon pays. It's essential to do your research and find a company that is well balanced. Generally, you'll want to look at the company's debt, age, payout ratio, and dividend growth. Each of these is an essential factor. Although you may want to get the highest payout ratio, if the company is in a lot of debt, it may not be able to sustainably pay dividends for too long. Look at REITs differently than you might a typical stock. Typically, with a stock, you want to see the price go up and up to the moon. The better the stock does, the more money you make. With REITs, your investment is less of a gamble and needs to be considered. REITs are typically not going to boom and make you wealthy overnight. They are a secure passive income that, when added to, will make you a lot of money. When you're a landlord, you don't expect your tenants to pay you more and more each month. You want consistent payments each month and expect some long-term growth. Instead of your savings account earning you less than 1% yearly, why not invest in REITs? Each month, you'll have more and more shares and in turn receive more and more dividends. Then you can use the power of compounding to reinvest and start to snowball your money. When you find the right REIT, whether it's land being rented to hospitals, grocery chains, restaurants, or warehouses, you can become part of the real estate market without all the worry.